What we're seeing unfold in the silver market right now is not normal, not seasonal, and definitely not something you'll find explained in a basic investing textbook. This is one of those moments where years from now people will say, that was obvious in hindsight, even though almost nobody acted on it in real time. And if you're wondering whether this is just another loud prediction in a market full of noise, stay with me, because this story is grounded in structure, not hype. A respected market veteran with more than 4 decades of experience has stepped forward with a forecast that has rattled even seasoned investors. Michael Oliver, a momentum structural analyst best known for calling the 1987 stock market crash well before it happened, believes silver is no longer playing by the old rules. In his view, silver is breaking out of a price constraint that has held it down for nearly half a century. Not 5 years, not 10, 50. His base case? Now, before your internal alarm bells start screaming too good to be true, here's the key difference between this setup and the usual get-rich-quick stories. This is not built on leverage, meme enthusiasm, or speculative fantasies. It's built on a structural imbalance that's been forming quietly for years, largely ignored because silver had a reputation for going nowhere. In the next few minutes, I want to walk you through why many analysts believe silver is undergoing a historic repricing, why this moment is fundamentally different from past rallies, and what that means if your goal is not just speculation, but protecting and compounding real wealth in a world that's becoming increasingly unstable. To understand why this matters, you first need context. For roughly 5 decades, silver has been trapped. While gold marched higher, oil repriced multiple times, and industrial metals like copper reset to new realities, silver stayed boxed in. Every time it tried to escape, it was pushed back down. Imagine a pressure cooker sitting on the stove for 50 years. Heat kept building underneath, but the lid never moved. According to technical analysts, that lid is gone. Michael Oliver describes the current phase not as a rally, but as a transition into a new pricing regime. In other words, silver isn't just running up, it's being redefined. Historically, silver bull markets followed a predictable rhythm. Prices would rise, then correct for months, sometimes painfully, before climbing again. That staircase pattern trained investors to expect long pullbacks. That behavior has vanished. Recent corrections have lasted days, not months. A 16% drop, normally enough to shake out weak hands for an entire season, was completely erased in just 10 trading sessions. That tells you something important about who is buying. These are not short-term traders flipping contracts. These are buyers who need silver, not want it. Industrial users, sovereign entities, strategic holders who see dips as inventory opportunities, not warning signs. This is how a rising support floor forms. Each pullback stops higher than the last. Right now, that floor sits around $60, and every attempt to push below it has been aggressively absorbed. That alone should make you pay attention. But price behavior is only the surface. The real story is underneath, where 4 powerful forces are converging at the same time. First, and this one should genuinely concern anyone watching global resources, the world has been consuming more silver than it produces for at least 5 consecutive years. The annual shortfall is roughly 200 million ounces every year. No pause button, no quick fix. Demand simply exceeds supply, and the gap is growing. Why is this happening? 2 main reasons. The first is industrial demand, and it's not optional demand. Silver isn't T being used because it's S trendy, S being used because it's irreplaceable. Solar panels rely on silver's unmatched conductivity. China alone produces roughly 80 to 90% of the world's solar panels, and that sector is consuming enormous volumes of silver. Then there's artificial intelligence. Data centers are popping up everywhere, and they require complex electrical systems where silver plays a critical role. The AI boom isn't slowing, it's accelerating. Electric vehicles also require significantly more silver than traditional combustion cars. As transportation electrifies, silver demand from the auto sector keeps climbing. Add advanced electronics, medical devices, and communications technology, and you start to see the picture. This is not cyclical demand that disappears in a recession. This is structural demand baked into modern infrastructure. The second reason is supply, or rather, the lack of it. Mining is slow, painfully slow. From discovery to production, a new silver mine can take 10 years or more. Decades of suppressed prices discouraged investment, meaning fewer projects are coming online today. Existing mines are working through lower grade ore. Recycling helps, but it cannot close a 200 million ounce annual gap. As Michael Oliver points out, when markets ignore structural deficits for too long, price doesn't adjust politely, it adjusts violently. Decades of pressure release in a short window. He calls it lightning pricing, fast, sudden, and unforgiving to anyone who's unprepared. Now, let us talk about one of the most revealing metrics in precious metals, the gold to silver ratio. It simply measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold around $4,600 and silver near $80, the ratio sits close to 52 to 1. Over long periods, That ratio averages around 50 to 1. But here's the interesting part. During major precious metals bull markets, the ratio doesn't behave politely, it collapses. In past cycles, it has dropped to 30 to 1, even 20 to 1. When that happens, silver doesn't move, it explodes. Why? Because silver is a much smaller market. When large amounts of capital flow into precious metals, silver has to move dramatically to absorb it. There's simply not enough metal available at current prices. According to Oliver's analysis, a critical 10-year ceiling in silver's performance relative to gold has just been breached. This time, the base is wider, and wider bases tend to produce bigger moves. Run the numbers. If gold reaches $8,500, consistent with its historical bull market behavior, and the ratio compresses to 20 to 1, silver lands around $420. Even with conservative assumptions, gold at $5,000 and a 30 to 1 ratio puts silver near $166. That's not speculation. That's arithmetic grounded in history. Traditional investors obsess over price charts. Oliver argues that price is like a speedometer. It tells you how fast you're going, not how powerful the engine is. Momentum structural analysis looks at the engine, and silver's engine, according to his indicators, has been building power for years. In July 2020, silver's momentum broke through levels not seen in decades, while price was still in the 20s. That was the early signal. Since then, every internal metric has strengthened. The market structure has changed, and when structure changes, price eventually follows, usually faster than anyone expects. That's where we are now. Not at the end of a move, but potentially at the beginning of a repricing event that resets what silver is worth in the modern world. Whether you act on it or just watch it unfold, that part, as always, is up to you. If there's one mistake investors consistently make during historic market moves, it's assuming the old rules will protect them. History shows that when a market shifts from cyclical behavior into a structural transformation, the familiar indicators can become worse than useless. They can push you out right before the real money is made. Silver has already given us this lesson once, and it's quietly preparing to teach it again. Look back at the 1979 or 1980 silver surge. By conventional technical standards, the market looked overbought almost the entire way up. Indicators like the relative strength index sat in extreme territory for more than a year. 12 straight months. Imagine selling the moment your chart told you things were too hot. You'd have walked away feeling disciplined and responsible, and then watched silver run from the teens all the way to $50 without you. Small gains locked in, life-changing gains missed. That is exactly why Michael Oliver keeps repeating a simple warning. When a market undergoes a structural shift, traditional technical rules stop applying. Treating this move as just another normal rally is the fastest way to exit far too early. According to his momentum work, silver isn't even close to the exhaustion phase. This isn't the end of the move, it's the acceleration stage. When momentum finally does go parabolic, the kind of behavior that signals a real top, he'll see it. We're not there. Not even close. And while the industrial case for silver is already compelling on its own, there comes another layer unfolding beneath the surface, one that has nothing to do with solar panels or electric vehicles. It's monetary, and it's arguably even more powerful. Major economies are sitting on debt levels that no longer live in the realm of opinion. This is math. The United States, Japan, the United Kingdom, pick your favorite developed nation, are all dealing with debt to GDP ratios that simply cannot be serviced honestly. When bond markets start to wobble under that weight, central banks are left with only two real options. They can allow interest rates to rise, which would crush governments, corporations, and consumers simultaneously, or they can step in and buy the debt themselves. They've already chosen the second option, and that choice has consequences. Central bank intervention means currency creation on a massive scale. When new money is created to absorb government debt, every existing unit of currency loses a little bit of its purchasing power. That's not ideology, that's arithmetic. In those conditions, capital doesn't politely sit still. It looks for assets that exist outside the debt-based system. This is where gold and silver step back into their historical roles. These are not promises. They're not liabilities. They don't rely on someone else's balance sheet staying intact. And that's why central banks around the world have been buying gold at record levels. Sovereign wealth funds are quietly building precious metals reserves. This is a vote of no confidence, not in any one government, but in the structure of the system itself. When that flow of capital accelerates, it doesn't trickle into precious metals. It floods in. And silver, being the smaller and tighter market, tends to feel the impact most violently. At the same time, traditional financial assets are starting to look increasingly fragile. Oliver describes equity markets as dancing on glass, with long-term momentum indicators sitting at critical inflection points. His outlook for stocks isn't a mild pullback or a polite correction. He's talking about the possibility of a 50% decline in the S&P 500. That's not turbulence. That's structural damage. If and when that happens, capital won't rotate gently, it will run. And when money runs, It looks for tangible stores of value. We've seen this movie before. In the 1970s, stock markets went essentially nowhere for an entire decade. Meanwhile, gold rose from $35 to $850, and silver went from around $1.50 to $50. That wasn't a coincidence. It was a reallocation. Oliver believes we're entering another commodity supercycle, but this one is stronger than the last. The 1970s didn't have mass solar deployment. They didn't have electric vehicle mandates. They didn't have AI data centers consuming industrial metals at scale. Those demand drivers simply didn't exist. This time, they do, and the evidence isn't theoretical. It's already showing up in real-world data. Over the past few weeks alone, the comics reported that January silver delivery notices are already 3 times higher than the entire month of January last year. That's not paper trading. That's physical metal changing hands. The exchange itself introduced a new 100-ounce silver futures contract specifically to accommodate what it described as record retail demand. When exchanges start adjusting contract structures, they're not guessing. They're responding to pressure. Margin requirements have also been raised and restructured, shifting from fixed dollar amounts to a percentage of notional value. That's the exchange preparing for higher prices and higher volatility. In other words, they're bracing for impact. Over in China, silver prices on the Shanghai Futures Exchange approached and reportedly touched $100 per ounce, trading at meaningful premiums to Western markets. The United States Mint announced a delay in the release of 2026 American Silver Eagles, and when they finally became available, they sold out almost immediately. That's the official government mint struggling to keep up with demand. Retail dealers felt it too. At one point, bulk prices for American Silver Eagles briefly surged nearly $12 above spot. And perhaps, most telling of all, the U.S. Treasury Secretary convened a ministerial-level meeting focused specifically on securing critical mineral supply chains, including silver. Governments don't hold emergency meetings over commodities they think are abundant. These are not forecasts. These are events happening now. For investors willing to look beyond physical metal, the mining sector introduces another layer of opportunity and risk. Mining companies offer leverage, sometimes extreme leverage. The math is simple but powerful. A miner producing silver at $20 an ounce and selling it at $30 makes $10 per ounce. If silver rises to $100, that same company makes $80 per ounce. Profits don't double, they explode. Historically, mining stocks tend to move 3 to 5 times the underlying profit increase. An 8-fold jump in profit can translate into 20, 30, even 40-fold moves in share prices. We've seen this repeatedly. During the uranium boom, prices rose 7 times, while the best junior miners rose 50 times. Lithium prices climbed 13-fold. The best positioned lithium stocks rose over 100 times. Michael Oliver has been very clear on this point. He believes junior miners especially represent the greatest upside. He doesn't hedge that statement, he emphasizes it. But he also adds an important caveat. Selectivity matters. Not all miners are created equal. Some hedge production and cap their upside. Some operate in unstable jurisdictions. Some are run by management teams better at issuing press releases than building mines. The real opportunities lie with unhedged producers operating in stable regions like Canada, the United States, and Australia, led by competent management and backed by quality assets. These are not conservative investments. They are high-risk, high-reward positions, suitable only for the aggressive portion of a portfolio. And before anyone gets swept up in excitement, there's one reality that must be accepted up front. This market will be brutally volatile. Rick Rule, one of the most respected resource investors alive, offers a sobering reminder. During the 1970s gold bull market, while prices ultimately rose from $35 to $850, there was a 50% drawdown right in the middle of the run. Half the gains gone, temporarily. Investors who panicked during that decline locked in losses and missed the move from 100 to 850 that followed. This is the psychological cost of outsized returns. You don't get them without discomfort. Silver will shake people out. It always does. The question isn't whether volatility will come. It is whether I'll recognize it as noise or mistake it for the end of the story. Because if the structure really has changed, then what we're witnessing now isn't a finale. It's the opening act. One of the most misunderstood aspects of major bull markets is the assumption that they move in a straight line. They don't. In fact, the bigger the opportunity, the more violent the shakeouts tend to be along the way. Rick Rule puts this bluntly and without any sugarcoating. During a powerful silver bull market, a correction of 25 to 30% is not a possibility. It's a certainty. Not maybe, not if conditions change. It will happen. And it will happen for a reason. Those corrections are not signs that the trend is broken. They are part of the mechanism. They exist to flush out weak hands, over-leveraged speculators, and anyone who entered the market without conviction. At the same time, they create opportunity for disciplined investors who understand the bigger picture and are willing to endure discomfort. If that sounds unpleasant, that's because it is. Big returns are rarely comfortable. We've already seen a preview of this behavior. Silver recently dropped roughly 16% from its highs. For many participants, that felt like the beginning of the end. Social media turned gloomy, commentators resurfaced the usual bubble narratives, and panic selling followed. And then, almost as if on cue, the market snapped back. Within 10 trading sessions, the entire decline was erased. Those who sold locked in losses. Those who stayed patient or added on weakness were rewarded almost immediately. This is why silver is not suitable for everyone. It is not a market for day traders, nor for investors who need short-term liquidity or emotional reassurance from green screens every morning. If you're the kind of person who checks prices several times a day and feels your mood shift with every red candle, silver will probably do more harm than good. 20% swings are normal here. They come with the territory. But if you can reframe volatility as a feature rather than a flaw, the equation changes. In major bull markets, corrections are not failures. They are pauses, resets, and pressure releases. The investors who understand this and who maintain conviction during temporary drawdowns are the ones positioned to capture the real upside. Michael Oliver and other seasoned analysts are careful not to tell anyone what to buy or when to buy. What they do offer is a strategic framework. And that framework is grounded in experience, not emotion. For investors with little or no silver exposure, building a position gradually through dollar cost averaging over a 30 to 60-day window makes sense. It removes the stress of trying to pick the perfect entry point, which almost nobody gets right anyway. Systematic buying smooths out volatility and reduces the risk of committing all capital at a short-term peak. Physical silver, coins, or bars offers the most direct exposure. There is no counterparty risk. You own the metal outright. It doesn't depend on a balance sheet, a clearinghouse, or a promise. For more aggressive investors who understand and accept higher risk, mining equities provide leverage to the silver price. But this is where discipline becomes critical. Not all mining companies benefit equally from rising prices. Some hedge their production, capping upside. Others operate in jurisdictions where political risk can erase gains overnight. Management quality varies widely. The most attractive opportunities tend to be unhedged producers operating in stable regions like Canada, the United States, and Australia, with strong balance sheets and competent leadership. Junior miners, in particular, offer the highest potential returns, but also the highest volatility. A 40 to 50% drawdown in a junior miner during a bull market is not unusual. It should be expected. Capital allocated here must be capital you can afford to see fluctuate wildly without forcing emotional decisions. Just as important as entry is time horizon. Oliver's analysis points toward the second quarter of 2026 as a critical window. If that's your framework, then price action in February or March is largely irrelevant. Noise. The question isn't where silver trades next week. It's where it stands in April, May, and June. Investors who lack a defined time frame tend to react emotionally to short-term volatility. Those who have one can filter out distractions. An exit strategy matters too. No bull market lasts forever. Mania phases end badly. Oliver has spent 4 decades studying momentum behavior at major market tops. When momentum begins to break down decisively, that's the signal to start taking profits. Not at the exact top, that's a fantasy, but after the bulk of the move has played out. Discipline on the way out matters just as much as discipline on the way in. Zooming out helps put all of this in perspective. Commodity history follows a remarkably consistent pattern. When a commodity trades in a range for decades, fundamental imbalances build quietly beneath the surface. Supply and demand evolve, but price remains artificially constrained. Eventually, resistance gives way. When it does, the repricing tends to be violent and compressed in time. Copper is a textbook example. It traded between roughly 60 cents and $1.20 for nearly 20 years. When it finally broke out in the early 2000s, it ran to $4.50 by 2011. Early participants made 7 times their money. Lead spent 3 decades hovering around 50 cents per pound. After its breakout in 2007, it surged to 1.75 in less than 2 years, a 3.5-fold move. Michael Oliver's momentum system identified both of those breakouts early. Clients who followed the signals captured the majority of those gains. He now argues that silver is displaying the same technical setup, but with even stronger fundamentals. The supply deficit is more severe. Industrial demand is growing faster. The monetary backdrop is far more unstable. That's why his targets sound aggressive. A minimum of $200, a potential spike toward $500 in a mania scenario. These numbers aren't pulled from thin air. They're derived from historical precedent applied to current conditions. It's also telling what isn't happening. Mainstream financial media has shown little urgency around silver. When it is mentioned, the tone is often dismissive. Already up too much. Overbought. Bubble forming. Ironically, this skepticism is bullish. Major bull markets don't begin with wall-to-wall coverage and cocktail party chatter. They begin quietly, with professional capital positioning early, while the broader public remains disengaged. The mania phase comes later. That's when silver leads the evening news. That's when coin shops have lines out the door. That's when your neighbor, your cousin, and your rideshare driver all ask how to buy silver. We are nowhere near that phase. Retail participation remains muted. Institutional money is doing the heavy lifting behind the scenes. Oliver describes the current phase as early acceleration, what he calls leg 2. The base is complete. The breakout is confirmed. The next stage is the powerful advance that eventually forces mainstream attention. By the time the public fully realizes what's happening, silver could already be trading north of $150. At that point, the easy gains are gone. This is why his message, that it's not too late, matters right now. The opportunity still exists, but the window is not unlimited. Step back and look at the convergence, a structural supply deficit that cannot be resolved quickly. Industrial demand drivers that are accelerating, not slowing. A global monetary system under visible strain. Technical breakouts that historically precede explosive moves. And an analyst with a 40-year track record who correctly anticipated the 1987 crash and major commodity breakouts, stating clearly that silver has entered a new price reality. His base target is $200 per ounce by the second quarter of 2026, roughly 4 to 6 months away. His upside scenario approaches $500. From current levels near $88, that represents potential returns of 2.3 to 5.7 times. At this point, there are only a few choices. You can dismiss it as hype, as many will. You can assume the move is over simply because prices are higher than they used to be. Or you can examine the data objectively, supply deficits, demand trends, technical structure, monetary dynamics, and decide whether silver deserves a place in your broader strategy. This isn't about betting everything on one asset. It's about recognizing asymmetric risk-reward when it appears. Downside from current levels is likely temporary and supported technically. Upside, if these forces continue to play out, could be transformational. Time is the critical variable. If Oliver's timeline proves accurate, and his history suggests he deserves attention, the runway is measured in months, not years. To be absolutely clear, none of this is financial advice. No one is telling you what to buy or how much to allocate. The responsibility is yours. Do your own research. Know your risk tolerance. Never invest money you can't afford to lose. But also don't ignore structural shifts simply because they feel uncomfortable or because conventional wisdom insists you are late. Oliver's core message is straightforward. Silver has broken through a 50-year ceiling. Market structure has changed. The buyers are different. Momentum is unprecedented. Fundamentals are stronger than at any point in modern history. And by his analysis, we are early in this transformation, not late. The roadmap is visible. The timeline is defined. The evidence continues to show up in real-time market behavior. What you choose to do with that information will determine whether, months from now, you look back with clarity or with regret.